everyone. Thanks so much for joining. My name is Denise Loria. I'm the Special Projects and Operations Manager at AFC. We're thrilled to have you for today's webinar. We have a great lineup in store for you guys. If anybody has any questions throughout the webinar, feel free to drop them in the chat or in the Q&A feature. I will be monitoring. We are covering a lot of information, so in the event we don't get to your question, I'll drop my email address. Feel free to email and I will follow up with you. This webinar is in collaboration with our legal advisory member, Chapman. It will be recorded, so in the event you have to jump, it will be posted on the AFC website and included in our weekly wrap that goes out tomorrow. So without further ado, I'm going to pass it over to Mark, who's going to get the conversation started.
Great. Thanks, Denise. And welcome to the American Fintech Council's webinar on the current state of fintech lending, new rules, risks, and opportunities, which we have described in terms of the good, the bad, and the ugly, and then we'll cover those. My name's Mark Franson. I'm the practice group leader of the Compliance, Regulatory, and Payments practice at Chapman and Cutler, and am also, some of you are familiar with this publication, The Regulation of Marketplace Lending, and that's what we put out every year about marketplace lending, and I'm serving as moderator on today's panel and bringing together views from both legal, bank, and fintech perspectives. So we hope that will be valuable to everyone. And we will have our panel briefly introduce themselves. Let's start with you, Tobias.
Hi, I'm Tobias Moon. I'm a partner at Chapman and focus on regulatory and partnership kind of structuring issues. So excited to be here and looking forward to working with everybody.
Great. Erica.
Sure. I'm Erica Cooley. I'm one of the co-founders and the Chief Legal and Risk Officer at Lead Bank. Lead is a financial infrastructure provider that unites the traditional banking system with our fintech and digital assets clients to open the aperture of lending and other financial services in a very technology forward way.
Great. And Danielle.
Hi everyone, Danielle Herring here. I'm the Director of Regulatory Affairs at Upgrade. Upgrade is a financial technology company that offers affordable and responsible credit and mobile banking products to mainstream consumers. And looking forward to speaking with everyone today.
And Kate.
Sure. Nice to see everybody. I'm Kate Layton. I'm the Chief Legal Officer at Opportune. So Opportune is a mission-driven financial services company. We're focused on helping consumers what we see as the two biggest hurdles to financial stability, access to affordable credit and building adequate savings.
Great. So let's get right into the good, the bad, and the ugly. As to the good, the industry's been watching a California court case for a few years now, and the issue has been whether the bank or the fintech is the true lender. And that, of course, has implications for many folks in the marketplace industry. And in May, the court finally issued a decision ruling that the bank was the true lender. That's good news. Although a notice of appeal has been filed last week by the state. So Tobias is going to give us a little rundown on the case and things that the court pointed out and how maybe bank programs might be structured so that the bank is deemed to be the true lender.
Yeah, thanks, Mark. So as Mark mentioned, the industry has been watching this case for a while. And just a little step back, the whole reason the case got started was because OppFi took the unusual step of actually suing the DFPI. And another little fun fact for this is the lawsuit kind of originated out of an examination that OppFi was having with the DFPI, where OppFi got wind that the DFPI was going to basically, in this examination, say that they were, in fact, the lender on loans of $2,500 to $10,000. And those loans would need to be subject to the 36% rate cap for those loans under the California financing law. OppFi obviously disagreed, since these were all funded through a third-party sponsor bank, who then sold receivables and alike to OppFi. So OppFi took the step of being a little bit more proactive and suing them directly. So just wanted to make sure we got that situated first. The bank was FinWise Bank, which is a Utah state chartered bank. So that's important for usury. There's no restrictions. So obviously that direct provision conflicted with California's 36% cap. So, and so just another quick clarification, there was no dispute by OppFi the DFPI that, in fact, listed on the loan documents and things like that was the actual bank. And that's important because now we're going to get into some of the key consideration points that the court focused on as to why it ultimately ruled that FinWise and not OppFi was the lender. And really, it boiled down to 5 basic big buckets. One is the application process and underwriting criteria. 2 is the funding of the loans. 3 is the ownership of the loans, marketing, and then lastly, compliance. So with regard to the application process, the court took a lot of detail in noting that, the whole process was owned by the bank, not OppFi. It even said that the bank engaged in a separate underwriting process after OppFi seemingly engaged in the underwriting. The other big point, and this is something that we've kind of stressed a lot to our fintech clients, is that the bank is ultimately solely in control of the underwriting. The bank can certainly take information in from the fintech, but it's ultimately the bank's decision whether or not to change any of that underwriting criteria. So what does that mean in a practical world? It means there's no manual overrides of the underwriting. If you want to get something approved, you have to run it through the bank. So those are the big factors there. Next thing, for funding of the loans, the key points were the loans were actually funded with the bank's own money out of the bank's accounts. The fintech, according to the case, OppFi did not provide any of the funds for the funding. So no surprise there that the bank was also listed as the owner or the lender of record on all of the loan documents. So the court made the conclusion that, hey, FinWise is the one who's funding all these loans, not OppFi. Again, the next bucket was ownership of loans, and the bank retained legal title and at least 5% economic interest in each loan, which is an important factor because the bank said, the court was saying the bank has an ongoing economic interest. The bank holds the legal title to these assets. And at all times, the bank also received, and this was something a little bit new that Mark and I have talked about, which is the bank actually received program fees and servicing fees, and the court noted that that's actually a positive factor for showing that the bank is a true lender, in the fact that it still gets an ongoing economic interest in the form of those fees. The next one was marketing. The bank had complete control over all marketing changes. The court took painstaking detail to talk about the process and how it could take quite some time for OppFi to propose changes to marketing materials, introduce new channels of marketing, things like that, and that the bank had to approve each and every one of them, and they couldn't really proceed until it was all done, meaning they couldn't operationalize any of those marketing material or a new channel until the bank approved it. And then lastly, which isn't a surprise, but it was focused on compliance, which is the bank is the one who is in charge of the compliance program. The bank needed to conduct periodic audits of the compliance program, and that's what they did. They reported to their board on how the fintech was doing in terms of issues from the perspective of, the loan performance, but also just the fintech's own compliance program. So, and looking at the risk factors to the bank also, and then reporting them up to the board. So there's a bunch of stuff there that I think is good for the industry. And then lastly, reviewing of the fintech's policies and procedures, at least periodically, I think, no less than annually, was a key factor that was pointed out by the court. So as Mark mentioned, the case ultimately, OppFi won a summary judgment that ruled that they were not the true lender. The DFPI appealed on the 21st of July. And what this case will mean is if OppFi wins, obviously that's just more of the same, and it's a very big win for the industry. However, if the DFPI wins, it's slightly bad news for the industry because, obviously the true lender fact, but also on top of that, you're going to have to get licensed, because currently the way it works in California is if you broker to a bank, you're actually exempt from the California financing laws licensing requirement. because that requirement says that a broker is someone who sends loans to another finance lender, which obviously a bank isn't, so they're exempt. But if you're going to be deemed the true lender, then you would need the license. So it would have pretty significant ramifications on two fronts. One, the true lender front, but then also on a state licensing front for the fintech. So I'll turn it back to Mark.
Yeah. So, is the OppFi program, as Tobias described it, somewhat typical, or are we going to see some changes in programs as a result of the decision? So, first, let's get the bank perspective. Erica?
Sure. Thanks so much, Mark. I think that there's definitely fine tuning that can be done around the margins, but I think holistically, these programs have been well structured in order to make it abundantly clear that it is the bank that is taking the risk, it is the bank that is taking the responsibility. It's not new or novel for banks to work with third-party service providers or to utilize third parties as it relates to credit underwriting. I think when you think about innovations around credit underwriting, FICO is in itself a model, it's machine learning. And so utilizing that from a fintech partner as opposed to a CRA, all of those are just components in sort of to what my friends on the panel were saying, opening the aperture of lending in a responsible manner. So do I think that the case will have an impact? I think that there are definitely marginal improvements that can be made in every program. But I think that every program also has to be looked at holistically. Like if the bank is not able to articulate what the program is and advocate for it and really understand it to its core primitives, then it's probably not the bank you want to be working with holistically. But I don't see a marginal material shift in what we're doing with our partners.
Yeah. And Kate, how about from the fintech side of things?
Yeah, I mean, I agree wholeheartedly with what Erica said. I mean, I think, we're not making wholesale changes as a result of the decision. I think it's more of I think for now it's a good fact. I think it's a useful validation of the controls, that a responsible bank partnership program should already have in place. I mean, we'll see what happens with the appeal. But I mean, I think it also, it's important to have the right structure in the contracts, but I think the decision also points to just the importance of maintaining a good, strong sort of evidentiary record of, good governance and bank oversight and, everything that Eric already said.
Yeah. So California is spending a great deal of effort and money on this case. So I think some people have asked, well, why haven't they just enacted a true lender or anti-evasion law like some other states have? Danielle, any insights on that from the governmental relations point of view?
Yeah, for sure. At the moment, California has not introduced a true lender anti-evasion bill, and I haven't heard of one coming down the pipeline. I think with the OppFi decision, it might not be a top priority right now to sort of, and the legislature might be waiting to see how the OppFi decision sort of plays out. If the DFPI does lose the OppFi case, we could potentially see legislation. But right now, there's been no immediate move, or at least not that I've heard, on a true lender bill coming down, although never say never.
Yeah. And I know, Tobias, you mentioned licensing. So if it goes south and people have to get licensed, what's the, it's not a great thing in California for that, is it?
No, no, it would be terrible for that. I mean, all the fintechs would have to basically get licensed. Bear in mind, they already have to get the debt collection license, right? Because they're servicing in fintechs where they're not buying 100% of the loan, they're servicing for others. So they might have to get that. And then, of course, if you have the CFL license, that gives you an exemption from the debt collection license. So then you have two licenses and you only need one. So it could be kind of messy from a licensing perspective, and not ideal for sure.
And of course, it takes a long time to get a license out there. So it's not like you can just turn the
Yeah.
switch and
Yeah, it takes a
things are
year
good.
at least. And with the fintech relationships and with the case, the vast majority of the fintechs that I've spoken to, it's taking 2 to 3 years plus, because what California did is they received an application. If they found out you were in a fintech partnership, they just kicked you immediately to an enforcement attorney to process. And the only fintechs I know who have gotten out of that is if they've said, we're actually trying to make California loans as well, direct loans, and then they have gotten approved, but not after you have gone through and you have to actually, I've successfully done this, you have to actually talk to the enforcement attorneys and push it through. So it's a mess on the licensing front, and this case kind of added to it, because the moment the case got filed, all the fintechs got funneled over to that process.
And one of the points that you mentioned was that, at least to some degree, the bank in the OppFi case did some review of the loans prior to funding, and a lot of questions have come up about that since the case. Since in many programs, the fintech is the service provider and just implements the underwriting criteria and gives an accept or reject decision. And this suggests that maybe there's some other step that might need to be taken in terms of that. Again, Eric, is that one of the tweaks that we're looking at, or something else?
Yeah, so because we at Lead, we focus on sort of a technologically forward infrastructure provider, we already have a final credit check that all of our sort of loan application, loan sale programs go through. That being said, I do always hesitate for these cases to hyper focus on one aspect because when I think about any of our programs, there's so many component parts that go into the analysis, and there's so many differentiators in, focusing on making every product and every program homogenous. I don't think really follows the spirit or the intent for banking partners or for their fintech partners. So where we really try to focus is like the totality of the circumstances, to put on my lawyer hat for the day. And so, what does the program look like holistically? How do all of those factors fit together? Are we retaining? Are we utilizing whole loan sales? Are we utilizing participations? Are we a balance sheet provider? Like all of those kind of component parts need to go in and not just be focused on one aspect, which is the underwriting component. And I often liken a lot of the innovations around credit underwriting to a FICO credit box. I don't go through and rerun, nor would I have the ability to rerun FICO's model to confirm that a 700 FICO is actually a 700 FICO. So why should a machine learning model that has been developed with proprietary data by a fintech be treated differently from sort of an oversight perspective? And we spend a lot of time at Lead on MRM. I promise I'm fun at parties. I don't just talk about model risk management, but sometimes I talk about financial crimes. No, I'm just kidding. I actually do. But in that understanding the model, the signals, and having that sort of governance aspect, to Tobias's point, and reporting on that within the bank to management and to our board, I think is good health and hygiene when it comes to these programs, and understanding how the credit decisions are being made and that they fit within the bank's risk appetite. But I don't think that an additional check is the sort of silver bullet that ends any true lender challenges. I think that we have to look at all of these programs, holistically.
Yeah. And Kate, how important is this from your perspective? Or if it's not there,
No, I think it's
still okay?
important. I mean, I think the real question is, does the bank have meaningful involvement sort of before and during origination? But I would separate that into sort of two separate concepts, between individual loan review versus bank control, over the underwriting, an underwriting process. And I think the key question there is just, whether the bank owns and governs the decision framework, not like whether somebody at the bank is literally pressing the approval button on every loan. And I think especially, for a company like us where you have a fully automated, the originations process the decisioning process is fully automated. So making sure that the bank, understands the framework, approves it, monitors it, has the right to change or stop it. I think those are all key points. But again, does somebody need to be going in and revalidating every single loan before it's, dispersed? I think the answer to that is no.
And it would materially impact the ability to serve the markets that perhaps
Right.
don't have other aspects and avenues. If you have to have a human in the loop component, it sort of takes out what's been developed by fintech, which has been so transformational in terms of opening the aperture of lending and financial services. So it also is like, is the juice really worth the squeeze to make a human being click a button at this point in our technological evolution?
Yeah. And the timing of it, right, too. It would take more time to actually do it. So
Yeah, and as Erica said, I think there's the other two key components about the, upfront in the model risk management process, and then, audit on the back end as well.
yeah, right. Well, let's switch gears for a second from the good to the bad. State legislators have for some time now been trying to do an end run around federal preemption and targeting marketplace programs. And we've certainly seen some states enacting those kinds of laws, and some I think have been beaten back. So what are we seeing on this front, Danielle?
Yeah, happy to touch on that. So we've seen quite a bit of movement over the past few years when it comes to anti-evasion legislation. I think mainly True Lender and DIDMCA opt-out legislation, and we seem to have seen the same set of states bringing similar legislation year after year. I'll touch on the DIDMCA opt-out and then go to True Lender. But on the DIDMCA opt-out side, Puerto Rico and Iowa have been opted out of DIDMCA for some time. And then starting in 2023, we started to see, states started to get this idea about DIDMCA opt-out legislation. Colorado passed HB 1229 to opt out of DIDMCA in 2023. And then in 2026, so just a few months ago, Oregon opted out of DIDMCA as well. And as we'll touch on in a bit, both are subject to intense litigation at the moment. So it'll be interesting to see what happens with the litigation on those two cases. On the legislation side, although there's been quite a bit of DIDMCA opt-out legislation that hasn't passed. 2025, there are bills in both Minnesota and Washington, D.C., as well as Rhode Island. And then Rhode Island is an interesting case because in 2025, they brought legislation, didn't pass. 2026, they brought legislation, and then this has been held for future study. So definitely lots happening on the DIDMCA opt-out side. Similar sort of cases happening on the True Lender side as well. In 2023, Connecticut passed a True Lender bill. 2024, Washington followed with the Washington Predatory Loan Prevention Act. And then we've also seen quite a bit of legislation when it comes to True Lender that hasn't passed. Virginia last year tried to pass a True Lender bill that was vetoed by the governor at the last moment. And then this year, even New York brought a True Lender bill, but it did not go anywhere. So definitely lots happening when it comes to True Lender and DIDMCA opt-out. Other rate efforts we've seen as well. Iowa, this past legislative session, passed a bill that went into effect in July and allowed Iowa's interest rates to align with 36% benchmark used by neighboring states. So it raised the rates that Iowa licensees could charge in Iowa. In terms of future prospects, I do think that we'll expect to see Rhode Island reintroduce the DIDMCA opt-out bill during their next legislative session. Also in Virginia, I expect to see this to come up again as well. The bill was vetoed, like I mentioned, by a Republican governor, but with the new Democratic governor in Virginia, sort of expect a higher likelihood of renewed legislative activity and stricter consumer protection framed efforts. But I will note AFC has done a great job of following the bills and advocating on members' behalf. So.
Yeah, you're right. The AFC has done a fantastic job on that. So we've got some of these bills in place in states, and some of them may require licensing. Some of them maybe even fintechs adhering to usury limits of the state. So on a practical and operational level, how do we deal with those laws? Do we get out of those states? Do we adhere to usury limits if we have them? What's happening there? And Kate, I'll start with you from the fintech side.
Sure. I think, for us, we may be a little bit of a different story historically because we started out as a, purely state licensed lender. We were in about 12 states under our own state licenses, but I think, in that case, we had probably 90, while it was 12 states, it was like 90 different versions of the product. And so it certainly, to be able to scale, to be able to, offer a responsible product that's an alternative to, more expensive or less transparent solutions, it's certainly helpful to us to be able to export a uniform product, through partnership with our, bank sponsors. And so, the bank preemption of state rates certainly helps, but I don't think that means that you can, avoid everything at the state level. We spend at Opportune, we spend a lot of time, considering state licensing requirements, whether that's marketing, brokering, servicing, et cetera, et cetera. So, we are licensed in a lot of the states that we're operating into. So yeah, Mark, to your point, that does lead to questions. I think we have seen, as Danielle mentioned, more leaning in on the state front to sort of manage things through the licensing scheme too. And so that, there are states that we're not operating in today, not necessarily because we don't think that we can, but it just adds a bit of complexity. And so we've decided for now, not to enter those states, but it certainly is a topic of consideration.
Yeah. And Erica, on the bank side, how are you managing this?
Yeah, I mean, first of all, I would love to give massive kudos to the AFC team and obviously sharing the amicus briefs yesterday from the FDIC and the OCC. I think in support of what AFC has been doing is incredibly helpful. As a state chartered non-member bank, this is something that we follow incredibly closely and obviously adhere to whatever the state usury laws are that we have to. And, Iowa and other states, I do think that unfortunately, it reduces access and availability of credit and customer choice, which I don't view as beneficial to the residents of that state. And so we try to advocate on behalf of those customers that they should have affordable, they should have access, and they should have customer choice, and not being able to serve various populations, because the reality of unsecured consumer lending at certain FICO bands is that it is a bit more expensive. We wouldn't be a responsible institution if we didn't think of that as well. And so from a safety and soundness perspective, we're hopeful to see that these don't become widespread and that there's a lot of thoughtfulness around this, and potentially, we're talking a lot with the prudential banking regulators also to ensure that community banks such as LEAD really have an equal footing with OCC chartered, as we're largely held to the same standards. So I think to Kate's point, we're following them, we're tracking them, we're complying as needed, but I haven't seen a lift in, customer help. I've seen more customer harm from a choice and availability perspective in terms of what we can do.
Yeah, and Tobias, I know you work a lot with licensing and state compliance types of issues. What are you seeing on that front? Are we getting more stringent or relaxed or what?
Yeah, I mean, kind of piggybacking on what Danielle mentioned, Washington is the one that put the limit at 25%. And so what effectively happens is fintechs are saying, okay, well, I need the license to broker. So I'm not going to be able to go above 25, but the banks are saying, well, wait a minute, but that doesn't apply to us. So it creates this weird dichotomy. And I think that's intentional by the states, right? Because they know they didn't opt out. So this is kind of an opt-out light in a way, because effectively they're getting to the same place to the extent that the bank offers it and doesn't really want to challenge the law or whatever, because the fintechs are just basically limited to the 25%. So I think there's a lot of hesitation to go past that if you're the fintechs, because many of both Connecticut and Washington have criminal penalty provisions, which again would not apply to the bank, because those states aren't saying, bank, you can't lend higher. They're just saying you can't deal with brokers who are brokering at that higher amount. Like the broker can't, because they're going to get a licensing violation. So I think what it's really shaping up to be is at some point there's going to be another showdown, and what it will be is a bank arguing, look, on the preemption front, you're interfering with my ability as a bank to conduct business, and it might not be like field preemption or whatever you want to call it, like direct preemption, but it's definitely indirect preemption. And I think that will be maybe something gearing up. But, and on the predominant economic interest front, which are the other types of statutes that Danielle mentioned, there's a lot of structuring that goes into those. We have clients who are set up where they might do just the brokering activity. The bank will then fund the loan, and then that same client will find a third party purchaser who purchases it, and then that same client deals with the servicing. So to avoid kind of the whole predominant economic interest theories and stuff like that, just to get through some of those states so that they could, in fact, maybe go up to higher amounts, et cetera, on the predominant economic interest side. But so there's lots of maneuvering going on, but I would say it definitely hurts the states that have them, because I share what Erica said. It just ultimately hurts the consumers of these states because they're getting cut off to access to good credit.
We talked a lot about anti-evasion as it relates to True Lender. I think when you're looking at some of these, and again, Lead plays in a weird space where we're a fintech, but we're also a community bank, and so I'm in a lot of very strange, like overlapping trade groups. But I think when you think about it, that's essentially what this is doing, is it's an end run around the bank's ability to do business. And there is a Bank Service Providers Act, there is a federal oversight framework for these things. And now you have states that, from the bank's perspective, are materially overreaching in their jurisdiction to be able to basically informally regulate us under a regime that already exists that we're subject to. And so it's definitely the hot topic amongst the banking trades as well, how these can be challenged. But I couldn't agree more. Like, this will also come to a head, Tobias, to your point, and hopefully it ends in the right place, because it's hard to watch products be limited and innovation be limited in a way that I don't think was within the intent of these regulations.
Yeah, I think the hard piece is, even if you feel like you're 100%, the bank's 100% in the right, and there shouldn't be an issue. I mean, I think we're all very busy and you have to pick your battles to some extent. And so, again, to Erica's point, sometimes the answer is, well, it's easier just to withdraw or not enter the state. And, it just limits choices for consumers.
And nobody wants to be a litigant in a lawsuit, right? But it seems odd to me that, these laws have been on the books, some of them like here in Illinois for a few years, yet they've never been challenged, whether under, whether they violate, the Commerce Clause or preemption or the Bank Service Company Act, all of these things. So probably it is one of the next battles that we're going to be facing here anyway. And I know Danielle mentioned the opt-out states, and I think most people are fairly up to date. But just to sort of recap that briefly, we know that in Colorado, after a good district court decision, a panel at the 10th Circuit reversed that decision. There was a motion for a rehearing en banc at the 10th Circuit, which was granted, and the decision of the appellate panel was vacated. And actually, oral arguments are going to occur on August 18th, just in a couple of weeks from now, on that. And all the briefs have been filed. And I think about everybody in the world has filed amici briefs. So we'll see how that one turns out. And as Danielle said, in Oregon, that opt-out is also being challenged by 3 trade associations, and they have filed a motion for an injunction against the law being effective, although the law has actually gone into effect at this point. And a briefing schedule has been made that sort of ends in September. So it sounds like the court there is putting it on a fairly expedited basis. But the interesting thing is we really don't know what it means to opt out, right? And that's the subject of the litigation in the 10th Circuit, with the states saying, the law has this provision in it that says, the opt-out is for loans made in this state. So what's a loan made in this state? And of course, the states are saying, well, it's a loan to any of our residents. And the banks are saying, well, no, a loan is made where, like the FDIC has said for ages, it's where some of these non-ministerial acts take place, the approval of the credit, the funding of the loan, which would typically be where the banks are. So to a certain degree, it's a simple legal issue. Is the loan made in the state where the bank is or the state where the borrower lives? So we'll see how the 10th Circuit, deals with that. But the other point which they are making in that is the one I think, Erica, you mentioned, that this puts state banks on an unequal footing with national banks, and national banks aren't affected by the opt-outs at all. So what good is opting out, because your residents are still going to be subject to rates that you may not like from national banks. So it's an interesting conundrum that we have out there. And there's also, I think, Danielle, some legislation pending in Congress on this. So what's going on there?
Yeah, happy to touch on that as well. Yeah, it's interesting on the federal side. The American Lending Fairness Act of 2026, which was introduced earlier this year by 2 Ohio Republicans, Senator Morano and Representative Davidson. It's currently in committee. The core fix would be if a state opts out of DIDMCA's federal preemption, that opt-out would apply only to loans made by institutions chartered by that state, not to loans made by out-of-state, state-chartered banks relying on federal exportation authority. So it would legislatively resolve, a similar question in front of the 10th Circuit. What I've understood is that it has some fair bipartisan interest, although not super optimistic about it going anywhere this session of Congress, as their heads are down on other bills. But it is interesting because the bill does amplify the need for the FDIC and other prudential regulators to work on the issue in parity between federal and state banks. And even if the bill does not go anywhere, it does bring the issue back up on the federal side. So it will be interesting to see what happens there.
Yeah. And interesting, I think both the FDIC and the OCC have issued briefs in the Colorado action favoring the trade association in joining that particular law, which was a little bit of a flip-flop from in the past, where the FDIC took a different position, but now I guess we have different people at the FDIC. So I guess that that makes a difference, right?
No,
I don't
Mark,
know.
they're getting it right this time. They were wrong last time.
I,
I'll be the
I,
bank that says
I,
that on the call.
I
This is
totally
the right
agree.
answer.
I
Okay.
totally agree on that.
Okay.
And it was sort of interesting. One of the briefs actually threw it into the face of the FDIC. He says, "Here's a brief you filed several years ago in another case on the East Coast where you said the opposite." And so, this really isn't. It's a little bit disingenuous here. So anyway, anybody else want to say anything else about opt-outs before we move on, or we'll opt on to something else, I guess. So okay, the good, the bad, the ugly. One of the things that came to my mind recently is that, for a lot of us, marketplace lending has had a pretty good run. We haven't seen a lot of blowups in the space. Maybe the one that we're all somewhat familiar with was the Synapse situation, which still is somewhat unresolved. But I think banks and fintechs see some of this from time to time, and where either the service provider or another party involved in the transaction is having financial difficulty, operational difficulty, things like that, and therefore it becomes a stress situation, and everybody has to scramble to try to work out of that situation, and it puts really programs in a precarious position, particularly if a critical service provider goes belly up or something like that, and you're in the hands of a bankruptcy court where you have no control or anything like that. So that raises the question of can we sort of avoid those kinds of things happening? Again, how do banks sort of look at fintechs and monitor them so that we don't get into those ugly situations, Erica?
Well, I don't sleep much at night. No, I'm just kidding, Mark. I actually sleep fine. I think that, when you think about the pendulum and how it's sort of swung within the bank fintech partnership ecosystem, there were definitely banks that entered the sector as sort of a side of desk business, a new revenue driver, and maybe didn't fully have the understanding of how these programs need to be managed, the downside risk, and the customer harm risk. And so I think there has been a lot more in the sector on the bank side of tightening those controls. And, like this is our core business. So we've invested heavily in it, both from a human capital as well as a technology perspective. Because the reality is, when a key service provider, whether it's a fintech partner, a loan servicer, a core provider, anything happens, that's business continuity planning 101. And it needs to be a fundamental principle of all safe and sound institutions. There's also practical realities. When you're doing a service or transition, my background before I went to tech was in structured products. So servicing transition is messy and it's hard, and you see losses skyrocket, and it's just not an elegant solution, but it's a reality. So one is making sure that the data is something that the bank has or its backup service provider has readily accessible in the event that you're seeing some sort of financial challenges at your service provider. It also is in the contract, making sure that you're having the right triggers such that you can move from, call it a cold to a warm or a hot backup servicer, so that they can stand ready to take over the portfolio. But all of this goes into a holistic look at anyone that you're using as a critical service provider. And that's making sure that they're financially stable, they're stable from a data governance and infrastructure perspective. You have access to the key and like really, really important data that you would need, and that you have access to the customers. Like you have to have a way to contact people because, again, in the post Synapse era, can you control everything? You can't. But if you know who the customer is, will you get them the most elegant solution to get their money back? No. But if you have to go old school and mail people checks, knowing who the customer is, what their balance is, and how to get them a check, it's inelegant, it's archaic, it's not what I would want to do. But having that as sort of your downside protection becomes more and more important. And I think any bank in the sector should have been and should still be thinking about these things as part of their own business continuity planning and really testing the infrastructure that they're relying on.
Yeah. And Kate, how about from the fintech perspective, how do you deal if these issues come up or how to avoid them?
Yeah, I mean, I think I agree with what Erica said, but I mean, I think the other piece is, in the avoidance part. And I mean, I think, monitoring monitoring is important. I mean, we treat our, bank sponsors the same way, they go through, we apply our same third-party risk management principles to them. So we are watching from a, financial standpoint, we monitor press releases. But I think the key piece, like with any big partner, the key piece is transparency. And I think, for us, it's realizing that like they're not just a vendor, right? They're a regulated partner of ours, and then we're a public company, so vice versa. I think there are things that could happen at the bank that it could have a major impact on us that could lead to disclosure implications for us. And so it really is just making sure that, I think for any of our partners, we're looking to develop long-term, good relationships. And so it's making sure that you have those good, you can escalate problems if needed, that on both sides, the expectation is that you're going to bring something up before the problem gets worse. And I mean, things happen, emergencies can develop overnight, certainly, but, it's hoping to, I don't think anybody on this call would say that just sticking your head in the sand and hoping something's going to get better before you have to tell somebody about it on either side is the best approach. And so really it is, trying to flag those issues, work through them together. But then, also making sure we've got the right, at least on our side, making sure we've got the right contractual provisions to protect us, make sure those disclosures are required, or that, if need be, we can, we could move and exit the relationship if, that becomes a necessity.
It's funny because we keep using the word relationship, and I often liken these to like a marriage. Like there's good days and there's bad days on both, but you have to have that sort of, I mean, I'm not married, but allegedly this is how marriages work. Like you have to have that open line of communication and dialogue between your bank and your critical, because there's an existential risk on both sides. And so I think that that's the critical part is like the sticking your head in the sand, I think really resonates. Like you have to have and be asking the hard questions to each other and know the business that all of your service providers and your bank are in, because it does have an impact on you guys holistically. And so I think that if your bank's not willing to have those quote unquote hard conversations, I think that's a very telling thing.
And I guess Tobias, right? Something could happen to the bank too. The bank could have issues. What happens? What happens there?
Yeah, I mean, we've seen it, right? Where banks have been told by the regulators, like, you're out of this program, and then you're stuck as a fintech kind of looking for other options. So one of the things that we always tell clients is to make sure that you're thinking about licensing, not just for your fintech partnerships, but maybe even get the lender licenses as a backup worst case scenario. Or what you're seeing more frequently is that a lot of fintechs have multiple banks as their partners to spread that risk out, right? Because it's become so integral to their operations that if one bank went away, that they could easily flip it over to the other side and they wouldn't be able to recover. So it's definitely, I think, growing in that regard, especially as, if more and more states opt out, I think you're going to see more and more of that.
And I'm not sure that I've seen any sort of legislation on this front, Danielle. I mean, is there anything out there that you're aware of where, they're trying to put the clamps down on bad things that might happen in these relationships? Or
No, similar to you, Mark. I have not seen any, although that doesn't mean it won't come up anytime soon in one state, and then will be followed by many states.
Well, let's hope if there are any regulators on the line, we didn't give them a new thing to think about. But anyway, so let's again switch gears a little bit. There's also things that could be good or could be bad or could be ugly depending upon who you are and where you are in the marketplace ecosystem. For example, we're all very much aware that many fintechs are out there filing for national bank charters. Certainly others are considering it that may not have filed yet. Sort of interesting that some of these were actually the people who started this industry who said, hey, we're the disruptors and we don't want anything to do with banks. And now they're wanting to be banks. Tobias, why do they want to be banks?
I mean, I think it's the risk we just talked about. It's the uniformity of it. It's the, growing concern over legislative fronts, whether it's the opt-out or the actual PEI slash, you're limited to certain interest rate laws. I just think there's concerns about all those things and risks to their model, and they're just sick and tired of it, honestly. And they're just like, well, I'll just go maybe try to become a bank. And, that's okay, but there's other things that you have to deal with there. You have to have a seasoned management team. I mean, Erica can attest this better than I can. You have to have a seasoned management team. There's certain things you can and cannot do with your capital. So, I think a lot of the fintechs that are doing this are having to hire bank officials to run companies or banks that are, in kind of the stages of getting approved. So it's definitely a big move, and it's definitely a trend. We see it in particular on the money transmission side, where people are trying to get the OCC bank trust charter. So I think it's probably going to happen until maybe we have a different administration, but we'll see.
Yeah. And so, with some of these fintechs, getting charters and things like that, is this going to be a game changer? Again, from the bank perspective, I mean, could you lose clients, or is there new opportunities to bring more people, new entrants in? How's banks looking at this, Erica?
Yeah, and I think I sit in once again, in a weird intersection because before I started this venture, I was general counsel over and led Block's team to get their ILC charter. So I've seen it on both sides. And I think to Tobias's point, understanding the implications, not just in terms of the financial realities, the valuation multiples, but also the way of operating in a regulated financial institution is often very different from how a lot of fintechs operate. From a profitability analysis, focusing less on growth and more on safety and soundness, all of those go into the calculus, I think, of whether you build, buy, or partner. And so I think that we will definitely see a lot of people get approved and hopefully be successful even with a change of administration. So there will be clients that will go and do their own charter. I think, again, getting out of your de novo period, being able to test new products, things like that are probably not likely. So we don't see an immediate sort of existential threat to our business. But I do think that this is another place where banks need to remain nimble and tech focused to make sure that we're not lagging behind, but really leading the way on how we can promote these types of partnerships, but also to our existing partners who may be getting charters, find ways to continue those partnerships. Because again, even with your own charter, you might want redundancy with a banking partner to ensure that if there is a challenge, especially at a de novo institution, you have a fallback and a fall safe with somebody who's been in the sector for quite some time and really understands, how to manage these programs. So I think there's a lot more to come. I think we're going to see more applicants. And I think that, we're excited to see, technology push forward the banking system, but I do think that there's a lot of challenges too. And there's a lot of things like CRA that maybe aren't as modern that you have to comply with as a bank that could be challenges to fintechs.
Yeah, and I'll push AFC one more time. One of their recent webinars dealt with sort of what happens once you get approved for a charter, and there's a lot of baggage that comes with that. So as we sort of talked about, it's sort of like the dog who catches the bone. Now that I've got it, what do I do with it? And it's maybe do you really want what you're wishing for? But we'll sort of see.
Tier one capital requirements aren't as fun as they sound right now, let me tell you.
Exactly. But will this sort of change the landscape of competition? Kate, how do you sort of look at that?
Yeah, I think it's going to be a mix. I mean, I think that, for example, at Opportune, I mean, we built our, compliance management system, our third-party risk management, et cetera, to the agency guidance, to sort of bank level standards. So I think there is a sense, where people feel like, well, if I'm already doing all of this internally, if I become a bank, I could have greater control over, as we talked about earlier, the banks have a lot of control and decision-making authority and everything about how your business operates. And so I can definitely see the benefit of, having greater control over product design and, all of those types of decisions. That, and there's certainly funding opportunities, things of that sort. But I mean, I think it's an important calculus to consider, as you all said, like, then you're a bank. And, I think that does change sort of the company's potentially culture, cost structure, speed of execution. I mean, there are other things that go into that. And, even if you're doing it largely, internally at that level, there's just a lot of other things you have to consider. And I think it is expensive to scale those functions, to the level that would be expected. if you're dealing directly with the prudential regulators. And so I think it'll be a mix across the board. But it's certainly an interesting time.
Yeah, we'll sort of see how that shakes out. And speaking of interesting times, we're sort of been living, at least for the last little bit, in an era, I guess we can call it, of deregulation. Sometimes states trying to fill the gap with some of that. Um, so are states looking to sort of beef up their laws given what's happened at the federal level and the CFPB? Danielle, what do you see on that front?
Yeah, definitely. States have, and I think will continue to beef up laws on compliance. We've seen over the past year or so when federal standards have stalled or rolled back, active states, California, New York, Colorado, just to name a few, have passed their own state statutes. And over the past year, has definitely seen an uptick in state legislation alone. Since I've joined Upgrade and started, managing regulatory change management, went from, looking at a few state bills a month to dozens and dozens each month. So it's definitely seen an uptick. I will say when topics that have once big topics with the CFPB have now fallen on the states. One example is buy now, pay later. There was a CFPB BNPL interpretive rule that was withdrawn in 2025, and they said they didn't intend to issue a replacement rule. But then, states all of a sudden weren't waiting. 7 state coalitions, launched their own inquiry. New York and Illinois decided to pass laws to regulate buy now, pay later. New York last year passed the New York Buy Now, Pay Later Act as part of the 2026 budget, and is still working on proposed regulations, but the law is on the books. And then Illinois just last month enacted the Buy Now, Pay Later Consumer Protection Act with a compliance date of, I believe, January 1st, 2028. So states are definitely acting when there has been a void. I think another example of this is junk fees. On the federal level, there were a few major junk fee rules that were either dropped or repealed in the past few years. And then on the state level, just to name a few, you had New Jersey and New York that have recently, New Jersey, as the governors issued the executive order to have all agencies, identify deceptive fee practices. The attorney general's also offered guidance on fee misrepresentation. In the New York, there's a New York Senate bill, the Junk Fee Prevention Act, and then also New York City has brought a junk fee rule. So definitely there's, topics that the CFPB was once looking into, the states have definitely taken up. I think it's also, definitely to note, in May of this year, California governor appointed Rohit Chopra, the former CFPB director, as the inaugural secretary of California's Business and Consumer Services Agency, which houses the DFPI. And so while his appointment doesn't expand DFPI's statutory authority on paper, it does signal a more coordinated use of the tools the DFPI already has. So yeah, I definitely think that the states will only continue to beef up laws on compliance.
And even though the CFPB may be pulling back, it's my supposition, just based upon what I know, that probably banks and fintechs aren't cutting back in terms of what they're doing from compliance type functions. Is that correct or not correct? And Kate, what do you think?
Yeah, I mean, I'd echo what's already been said. I think it's more of an issue of, decentralization or, versus deregulation. I mean, we're certainly not, I never want to be in a position either where we're kind of whipsawing the business. And it's like, and we're definitely not saying like, throw all the controls to the wind, go do whatever you want. Because you never know, it might change or, I certainly think we've seen the states leaning in. But I do think it's a time of being able to sort of pressure test as decisions come up, sort of, again, thinking about like, what is our risk appetite in a particular area? Are there places where, we feel like we can move a little bit faster or do things a little bit differently than we did before, certainly guided by, what's the right thing for the, consumer. But yeah, I would say we haven't made, I certainly don't think we've made any dramatic changes in the way our business operates.
And Eric, I assume that's fairly true on the bank side too?
Yeah, we bank fintech and digital assets. We need to be administration agnostic if we're going to stand the test of time. So we haven't, but I do think that, just from a first principles basis, like everyone is rethinking the why behind everything that we're doing and where we can gain efficiencies, utilize automation, AI, things like that. But I don't think we're giving back any of the control. I think we're just trying to be more efficient and smarter about how we're doing our oversight frameworks.
Yeah. And you said it, Erica, the words AI, and AFC has said we can't have a webinar without mentioning AI.
I promise I didn't do that on purpose, Mark, but I teed you up really nicely.
No, that's that's great. So sort of the last topic here in the last couple minutes that we have is is AI going to change things on the lending front? And again, Kate, how about from the fintech side?
Yeah, I mean, maybe this is where I guess my nerdiness shines through. I mean, I think it's an exciting time to be working in this industry. I mean, I think it's interesting because you've got sort of everybody kind of on the level playing field, right? Trying to figure out exactly how you're going to both on the company side, the bank side, the regulator side. I think everybody's kind of thinking through how does this impact the way that we do things, and I think it will enable us to scale certain things faster. Obviously, making sure that you've got not just the human in the loop that's sort of signing off on things, but really thinking through like, how are we sure that all of this is working in the way it's supposed to? But I actually think there's places where it's going to allow us to do things, as opposed to like for compliance, for example, like you may be able to look at, while, one person only had so much time and you had to do things, sampling, you could look at a much broader set of what's going on in the business and, expedite those reviews and then, really put your time in the value added part of getting to that root cause analysis and things like that, as opposed to moving things from, one thing to a spreadsheet. And then, so I don't know. I think it's a very interesting, very exciting time to be working through all this.
And are we going to see things, Danielle, on the legislative side on this, I suspect?
Yes, for sure. I think every week there's a new AI bill in a new state. I think regulators are trying to figure out how to best regulate AI. On the federal side, Ranking Member Waters launched an RFI earlier this month on AI. There's Senator Warren's agentic AI bill, quite a few efforts on the federal side. And then on the state efforts, we're seeing legislation. I feel like every week, like I said, there's a new type of state legislation that's being introduced. I think a big trend we're seeing is on disclosures. Utah and Maine back in 2024 passed AI laws that, you had to have clear and conspicuous disclosures that, consumers are communicating with an AI agent. Seeing similar bills come up in New York. California has also been busy on the AI front with Regenerative AI Data Transparency Act, ADMT regulations. Michigan, the Department of Insurance and Financial Services issued a bulletin addressing the use of AI and, making sure companies are creating AI policies. Then, of course, have to mention Colorado, which is an interesting example where a state was, wanted to regulate AI and then received a bit of pushback. So a week before the effective date, repealed and replaced the law with a new law that goes into effect at the end of the year. So I think there's a lot and will continue to be a lot happening on the AI state legislative front.
Yeah, I think the
Yeah.
interesting. No, I
Go
was just
ahead.
going to jump in, Mark, and say, and maybe I'll put my plug in for AFC here and stay in Phil's good graces. But, I think that one of the things that we've seen is also just, and I appreciate the work that AFC and others have done. I mean, just part of, I think, what the hard thing is, there's like regulation coming out, for example, on the fair lending side. And, we've been doing a lot of work to say, well, there's already laws that cover that. Why do we need, AI is not making this any different, right? Like there's already regulation out there. Why do you need another bill that says the exact same thing, but from an AI perspective? And so appreciate the work that everybody's been doing on that front, just to not add to, well, now you got to do this in a slightly different manner when it's already taken care of. So.
And we look at a lot of agreements with banks, and for the very first time this week, I saw one that basically said the bank has to approve any use of AI by the fintech. So I don't know if Erica, if you're going to go that route or not, but it seems like that's an interesting approach anyway.
I think for fraud and underwriting, but the quickest way is automate a task you hate. Like I hate doing board reporting. I hope none of our board is on there. So like having my agent, Chad, pulls together my board reports and then I edit them. And so I think there's sort of those back office, sorry, my agent's name is Chad. So like there's sort of those back office functions that like are just driving efficiency and automation versus an agent or pushing like eng code to production or doing underwriting. Like there has to be that sort of balance in terms of what the oversight framework should look like.
Yeah.
Hey, Mark, we have an actual question. You ready?
Okay, what is that?
What are we seeing from the regulator side on the development and use of AI directly via the bank, but also fintech partners? And then second part is what are the levels of comfort regarding human in the loop structures versus autonomous agents? So I think I don't know that I'm seeing much from the regulator side, right? I mean, we're
I
seeing
think they're trying to get
legislation
up to
pass
speed,
all the
right?
time.
Yeah,
What's
they're
that?
trying to get up to speed, I think, on some of this too, right?
Yeah, exactly.
Yeah.
Exactly.
I
So
mean, wait
we'll
for
see
us to
more.
have you know your customer. Next, it's going to be know your agent.
Yeah,
It's
that's right.
coming.
Right.
KYA.
Uh,
Why?
I hate to say it, but we are out of time. But one lightning round, I want a yes or no answer from everyone. So will marketplace lenders be doing loans in crypto in the next 3 years? So Tobias?
Yes, they already are.
Danielle?
I guess I'll go with Tobias's answer as well.
Okay. Kate?
I mean, I think that's a yes. Yeah.
And Erica?
Yep.
I stacked it, Mark. I'm sorry.
Well, I don't have to break any tie there anyway. But so anyway, that's it. Thanks everyone thanks the panel. Thanks everyone for joining, the good, the bad, and the ugly. Hope we've given you some perspective on some of these things that are happening in the industry, and thanks to AFC.